Amsterdam retains share trading supremacy over London a year after Brexit. By Hugh Jones and Elizabeth Howcroft. London, Amsterdam ended 2021 as Europe's top share trading venue, holding its lead over London despite efforts by the British financial centre to make its equity markets more attractive after Brexit. Euro-denominated share trading by EU investors had to stop in Britain, and the country left the European Union on December 31, 2020. Much of the trading switched to Amsterdam, where pan-European Euronext has a base, along with the new post-Brexit operations of CBOE Global Markets and London Stock Exchange Group's Turquoise. Figures from CBOE Global Markets on Thursday show that average daily trading in Amsterdam last month totaled €8.97 billion, ahead of London's €8.32 billion. Amsterdam overtook London as a share trading venue soon after Brexit, but the British city had managed to nudge back ahead in June. Graphic, 2020. London towers above piers. https://fingfx.thomsonreuters.com/gfx/mkt/lbvgnjbbopq/2020.png. A deal with Switzerland to allow Swiss share trading to resume in London helped it claw back lost ground, but was not enough to secure the #1 spot for long as other initiatives failed to gain immediate traction. Britain in August made it easier to list special purpose acquisition companies, or SPACs, long the darlings of investors on Wall Street, but by November just one had listed. Euronext said it had 22 new SPAC listings, accounting for nearly half of all those coming to the market in Europe last year. Graphic, 2021, Amsterdam takes the lead. https://fingfx.thomsonreuters.com/gfx/mkt/for example pbkjovq/2021.png. Britain's finance ministry is facing calls from the financial sector to accelerate efforts to buttress UK capital market competitiveness. It's not a given NL1 and 2 TL14P that people will want to come to London, Catherine McGuinness, policy chief for the City of London, home to the financial district, told Reuters on Tuesday. The Financial Conduct Authority introduced more flexible rules last month. NL8 and 2 SN25Q for listings on LSEG's premium segment in a bid to lure more tech companies, which Wall Street has been so successful in attracting. LSEG said last week that 122 companies listed on its exchange in 2021, raising over $22.75 billion, its best year since 2007. Euronext, whose exchanges in Europe include Amsterdam, said last week it also had a record year with 212 new listings raising $29.42 billion. China Evergrande moves from Shenzhen HQ building to cut costs. Shenzhen, China. Heavily indebted property firm China Evergrande Group said on Monday that it has moved out of its headquarters in Shenzhen to another property in the city to cut costs, and was still registered in the southern Chinese city. The company issued its statement after Chinese media outlet The Paper reported that Evergrande had moved its headquarters from Shenzhen to nearby Guangzhou. Evergrande said it has moved out of Shenzhen's Excellence Center, which is owned by another company, to a building that Evergrande owns in the city, but gave no further details on the new setup. The world's most indebted developer, Evergrande is struggling to repay more than $300 billion in liabilities, including nearly $20 billion in offshore bonds deemed in cross-default by ratings agencies last month after it missed payment. On Monday afternoon, the company's logo had been partially removed on one side of the Excellence Center. Security personnel, accompanied by security vehicles, kept watch, and several of them said that the company had left the building last month. Last September, the Shenzhen building was the scene of chaotic protests, and investors crowded its lobby to demand repayment of loans and financial products. Last year, the Guangzhou government sent a working team to Evergrande, sources told Reuters. Sources have also said that lawsuits against the company from around China are being handled by a court in Guangzhou, which is the capital of Guangdong province, where Shenzhen is also located. Evergrande was founded in Guangzhou, moving to Shenzhen only in 2017. Last Tuesday, protests also began at the Guangzhou offices, with around 100 investors in financial products issued by the company gathering to express their worries about getting their money back. Small crowds of protesters have continued to gather near the site since, 10 protesters told Reuters. Tesla raises full self-driving software price to $12,000 in U.S., Musk says. Tesla Inc. Chief Executive Officer Elon Musk tweeted on Friday that the electric carmaker will raise the U.S. price of its advanced driver assistance software dubbed Full Self-Driving to $12,000 on January 17. The 20% price rise comes less than 2 years since Tesla raised full self-driving prices to $10,000 from $8,000 in 2020. Tesla FSD price rising to $12,000 on January 17. Just in the U.S. Musk tweeted. Musk also added that the monthly subscription price will rise when FSD goes to wide release. FSD price will rise as we get closer to FSD production code release, he tweeted. Tesla has been expanding the release of a test version of its upgraded FSD software, a system of driving assistance features, like automatically changing lanes and making turns, but the features do not make the vehicles autonomous. Designer Sunglasses founder admits insider trading plan. By Nate Raymond. Boston. The founder of a designer eyewear company, whose family has held investments and leadership roles in many major retailers like DSW Inc., has agreed to plead guilty to engaging in insider trading with two Florida men using information he learned from a cousin. Federal prosecutors in Boston disclosed in court papers on Thursday that David Schottenstein had agreed to plead guilty to conspiring to commit securities fraud and cooperate in the prosecution of a venture capital firm founder and an entrepreneur. A lawyer for Schottenstein, the founder of designer sunglasses company Prive Revo, did not respond to requests for comment. Prosecutors said Schottenstein, 38, traded on inside information he learned from a cousin who sat on the boards of directors of shoe retailer DSW and cannabis products company Green Growth Brand. Schottenstein traded ahead of a 2017 earnings announcement by DSW, the 2018 news that Albertsons Companies and Rite Aid Corp had agreed to merge, and a 2018 tender offer by GGB for Canadian cannabis-related business Aphria Inc., prosecutors said. The cousin's family business was part of an investment consortium involved in the Rite Aid transaction, which later failed. Schottenstein made more than $600,000 through his trades, the U.S. Securities and Exchange Commission said in a related lawsuit. Prosecutors said Schottenstein also illegally tipped two friends, Chris Bortnowski, the co-founder of Sackle Capital Management, and Ryan Shapiro, who founded inmate money transfer service provider JPay, to the expected news. Authorities said Bortnowski's traded ahead of all three announcements and Shapiro traded on tips about Rite Aid and Aphria. The SEC said Bortnowski made more than $4 million and Shapiro illegally reaped $121,000. They were initially charged last month and formally indicted on Thursday. James Fraccaro, Bortnowski's lawyer, said he is innocent. Martin Weinberg, Shapiro's attorney, said he is factually and legally innocent of today's allegations. DSW is now part of Designer Brands Incorporated. GGB filed for bankruptcy in 2020 following its failed bid for Aphria. Shares of Chinese developer Shimao Group bonds plummeted due to default on loan. Hong Kong/Shanghai shares of Chinese developer Shimao Group Holdings slumped on Friday, and trading of some its key units bonds was paused after the company defaulted on a trust loan payment, underscoring continued stress in China's property sector. Shimao's Hong Kong shares fell more than 18% after trading opened on Friday, while three Shanghai exchange-traded bonds issued by its unit Shanghai Shimao Co. tumbled more than 20%, triggering trading pauses over what the Shanghai Stock Exchange said was abnormal fluctuation. Three additional Shanghai Shimao bonds fell between 13% and 14%. Exchange data showed. The six bonds were last quoted at distressed levels of 40% to 60% off their face value. The falls come after a trust company, China Credit Trust Co., said on Thursday that Shimao Group defaulted on a loan after missing a 645 million yuan payment. On Friday, another Shimao unit, Shanghai Shimao Construction, said in a filing that it is in talks with China Credit Trust to resolve the outstanding payment, and that the missed payment will not accelerate payment requests in the open bond market.